The dividend argument is a difficult one. I mean, 90, basically, London Capital Group pays 80. But even that's pretty good, because if you actually owned the stock, you'd only get 70% or whatever it is. You'd have to pay tax at your tax rate on the revenue. So even 80% is pretty good. But what the spread betting companies have to take into account is that they don't want people to deliberately use spread betting or CFD trading to avoid taxes. So you have to make it slightly disadvantageous, not disadvantageous, but not quite as wonderful as it could be. Otherwise, you would run the risk of HMRC saying, you've just taken that huge CFD position, or that big, merely to avoid paying tax to HMRC. And London Capital Group set it at 80% 10 years ago, and we've stuck with it ever since. Yes, some at 90%, but in reality, not many people. Equities are not massive, and certainly dividend trading for spread betting is not a massive activity.
How do indices reflect the effect of dividend payouts on the individual constituents making up the index?
Exactly the same as it would in the real world. The spread betting companies calculate the fair value, and they look at what the dividends of the individual stocks are that are coming out. So if it's a big weighting stock and it's got a big dividend, then it'll have a certain number of FTSE points, and those are the points that get removed from the price of the real exchange. It gets removed from the price, so it actually gets handed to the client if they're long, and taken away from the client if they're short. But it's a straight calculation.